Chris Pollard is Managing Director and Head of Market Strategy at Cowen. Chris, thank you so much for joining us this afternoon. What do you think is really behind this renewed selling that we're seeing? Is this all because of those disappointing results and guidance from Meta Platforms, or is there something else at play here?
Sure. Well, thanks for having me. Good afternoon. I think that, the earnings misses, obviously the headlines earnings misses and the capitalization impact that the specific names today are having on the markets is driving a lot of the weakness. But if we take a step back and we think about why markets have been weak going on, not just for this year, but really into the latter part of 2021, it's been the hawkish policy pivot. And that's not just in the US, but increasingly a global one. We saw Bank of England raise rates today. The pricing of the potential for an ECB rate hike is elevated. So the idea of a tightening of the monetary spigot is increasing. And certainly the idea that that is going to occur is going to lead to pressures on multiples. It's also going to move people a little bit inward on the risk curve as opposed to at more extremes of some of the less profitable companies in the market, a dynamic that we've seen really year to date. And so when you put it all together, it's really hawkishness first that's driving this weakness, but certainly some of the fundamental hiccups that we've seen are adding to that.
And so with all of this in mind, with the investors that seemed like they were going long re-entering on the 28th, the 31st of January, and what we had seen in that concerted move higher, if they have already picked their entry point to this point in time, do you expect that there's going to be any further buying activity to provide a backstop or a type of buoy?
So that's a great question. The move that we saw at the end of the month was really a reflexive response to how deeply oversold some of the technical factors in the market had become. The intensity of the downside move was truly historic in terms of how bad the year started. And when you look at some oscillator momentum measures, if you look at downside extension from, say, moving averages, the technical dynamics had become really extreme to the point where reflexivity should have been expected and indeed was realized. To the extent that there were inflows there, some of that was probably oriented around month-end dynamics and some recalibration in portfolios as a result of the drawdowns that we experienced over January. But from here, as we move through that phase, and as Jared was mentioning before I came on, the overhead resistance is really asserting itself here. And it's important to remember that, particularly with the NASDAQ and with the Russell specifically, the breakdowns that we saw in the second half of January have now stranded a tremendous amount of trading underwater. So the classic technical idea or concept of support becomes resistance is really coming into play. And that's where we hit our head earlier this week. So from here, we would expect weakness is going to persist. The idea of taking out those January lows is not an unrealistic one to hold. But we're going to have to see it's path dependent. I think in the very, very near term, downside is certainly the direction we would be focused on.
And in terms, Chris, of catalysts that we should be looking for, even as soon as tomorrow, when we get that new January jobs report out, do you think we're in that zone where bad news is good news in terms of how we might expect to see markets react to a potential downside surprise in the jobs report and what that actually might mean for monetary policy?
Sure. Yeah, you're right to point out the data backdrop is incredibly important, particularly in the first half of February here. The Fed has told us that their data dependence is really going to be what drives the realization of policy path here, specifically with the non-farm report this week. I think it's been pretty well teed up that there is likely going to be weakness. That weakness is going to be driven predominantly by the ongoing health considerations from Omicron. And the ability for people to look past that, I think, is going to be pretty elevated. So in my mind, in a very, very tactical sense, there's a bit of asymmetry around this release insofar as folks are expecting weakness, expecting a disappointment there. And if you do actually get a better release, something that shouldn't be completely ruled out, given the internal strength we've seen in the labor market going on, 6 months now, that could actually set up an additional hawkish result. But if we think about what the reaction function is from the central bank community and certainly from the Federal Reserve, it's pivoted fully towards the price side of the Fed's dual mandate. Next week, we're going to get CPI and PPI data. It is almost assured that those readings will be historically hot, particularly on a headline basis when we factor in the movements we've seen in commodities. commodities. But even on a core basis, the pressures that we're seeing and realizing at the start of this year are pretty elevated. In the press conference in January, following that FOMC meeting, Powell discussed the concept of him revising higher his full year outlook for inflation in 2022. And that sensitivity is going to be hard to remove from the committee, at least over the first half of this year, just given some of the base effect dynamics coupled with some of the supply demand dynamics that we're seeing in the commodity complex. And it's going to make it pretty challenging to see a pricing out of the hawkish policy path that markets are focused on at this point. So data is going to remain a headwind. You're right to bring up the concept of bad news equals good news, but I don't think that that's going to be a reality for markets, certainly not in the first quarter, but likely in the first half of this year.